And on today's show, rescuing defined benefit plan participants, part 5 of this week's series on defined benefit terminations and structured settlements, with industry expert Steve Pilger. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmark. Let's get down to business. Well, welcome, boy, a whole week under your belt here, Steve.
Time flies when you're having fun.
We're having fun too, and the reason I have fun is because when I'm in an area that I'm not really that deep in as an advisor, and here's a whole nother opportunity. I just don't really, I thought, my goodness, I kind of knew about structured settlements, kind of knew about that, but not the defined benefit plan rescue, especially frozen plans as well as planners who are looking for some kind of solution, which we have.
Right.
I want to talk about some of the concerns, when we're doing, as a participant, I'm just in my plan. I was told all I had to do was, stick it out with the company.
Yep.
They're making these, I'm making these contributions, I'll have a guarantee, and now all of a sudden that may not happen. Talk about why, from a plan participant, where do I go on this?
Well, plan participants, rightly so, based again on what we've seen in the media in recent years with plan changes and things going on with pension plans, is you're opening up USA Today or you're opening up your favorite local newspaper and you're saying, well, the promises that I was given at the time that these plans were put in place, my company was contributing to them. While I may not get what I thought I was going to get, I'm doing my job. And I'm going to see it through to retirement, but now I'm seeing that there's reductions in benefits, or this notion of my plan isn't fully funded, and so they have questions about what's going on here. Similarly, they may have received some communications from their plan sponsors indicating that there are some changes that are being put in place with their particular pension plan. You lump all that together, if I'm the average participant, just trying to do my job, knowing that I have this retirement benefit when I retire, I'm concerned. And I think as advisors, as professionals in our business that are talking to these participants and these types of issues come up, I think we need to make sure we're armed to be able to address some of those concerns, but also from the standpoint that, getting them to understand that their plan sponsors in many cases are looking at ways to improve and make sure that the promises they're making to you are going to be there when you retire.
I want you to touch on this subject just for a second, because I think there's some, maybe I'm wrong, delusion, because you have the Pension Benefit Guaranteed Corporation.
Correct.
And I'm saying, well, I'm not worried ultimately because they're going to pick up the tab. Well, I don't think it's dollar for dollar.
It isn't. It's pennies on the dollar.
Pennies on the dollar.
And again, media, sometimes being our friend, sometimes being our nemesis, it published reports have indicated that the PPGC, who basically ensures that those benefits are going to be there when you retire in your plan, they're underfunded themselves to the tune of $36 billion.
The Pension Benefit Guaranteed
The insurer itself
themselves have problems.
Has a deficit and running a deficit. Hence, what we're seeing now with them trying to play catch up in the form of significant premium increases that they're passing on to the plan administrators is they know they have a problem. So now we have a potential disconnect with, okay, what we thought was the guarantee to make sure my pension's going to be there. Well, it might not necessarily be what it's been laid out to be.
Well, as a plan participant, especially when you say, I'm just middle America Joe Lunch Bucket, I've been working for the corporation all my life, I depended on this retirement money. Now you're telling me not only is that may be in jeopardy at some discount, but now the very people that I thought this PPGC was supposed to back this up, and now they're not even funded enough to take care of that. It's going to be pennies on the dollar if something goes south.
Right.
I can see how this is really disconcerting. I see it a lot. So some of us, and I've learned, should we just forget the plan participation, and should we be in regular contribution plans then?
Short answer is no. Because again, the vast majority of these pension plans are going to pay off on all the commitments that they make to their plan participants. So in large measure, you're going to be fine there. It's obviously the ones that find themselves in some issue that kind of cast the shadow over the rest of the plans. That being said, we have definitely seen a trend on the part of companies to look at ways of, okay, we've had a pension plan for a number of years, but maybe now they've gravitated away. So hence these frozen status that you see some of these plans being in now, where they're no longer contributing to them on a move forward basis. And they've shifted gears towards some type of defined contributory plan, 401ks and the like, where now there's kind of a joint type of a contribution for ongoing deposits moving forward.
If I'm a plan participant, I receive a letter from my administrator telling me we're offering a lump sum buyout, or my pension got transferred to another insurance carrier. I mean, is that cause for alarm?
First of all, take a deep breath. That's the first step. Step two is hopefully you have a trusted advisor that you can now have a conversation, start a conversation with. Again, in some cases there might be decisions that your plan administrator is asking you to make. It might just be more of an advisory, hey, heads up, we have to let you know that some of these things are coming down the pike. Again, not letting the media, especially the negative parts of what we're seeing with pension plans and what's happening in the future of them. Take a deep breath and make sure you go seek answers to the questions that you have before you make any decisions about what you do or don't do with your pension. And it is and I use those words specifically, it is your pension.
It's my pension, but it doesn't sound like I got all that much control.
Well, how many things do we have control over in life?
I guess it's just an illusion all the way around. Well, when we come back from the break, I want to talk a little bit about settlement structures. What if I'm the person that's involved in it? I'm not the administrator, I'm not an advisor. I'm actually going through this myself. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Steve, I want to get right into it. If I'm an injured party, we're talking about structured settlements again. Do I know, as the injured party, what my options are? Do I have any idea what I can get out of this? What are the structure? Is my attorney going to help me on this? Is it my advisor? Who helps me make the decision?
My experience has been that the kind of the driving part of any of these structured settlements tends to come from the defense side, so maybe not necessarily the injured party. We always recommend that in the case of especially like an injury claim or something of that order, that we want to make sure that there's representation on both sides. And we being kind of the collective group of professionals that would help not only mediate, but then ultimately negotiate and execute a structured settlement. From an injured party standpoint, again, just in the previous segment when we talked about take a deep breath, and the hope is that you have a trusted financial advisor, someone who can help steer you along the right path, get you to the right resource to make sure that your issues and your claim is represented and not being dictated to you by someone else.
I'm always thinking if I'm injured and I had to go through something, I would think, well, I have needs today and I'm going to have future needs tomorrow. There's inflation. Do they incorporate all that into a settlement?
Absolutely. Anything from cost of living adjustments to that set out of the stream of payments. Maybe there's something where, and this comes up commonly with minor children, maybe lump sum distributions for college educations, or in special needs situations, maybe for large purchases, equipment, or certain things that are needed, over the life cycle for that individual. So these types of things can be built in. And again, it provides certainty on the part of the injured party that, okay, here's how this money is going to be accessed and paid to me on a move forward basis.
Now, and I've talked about, you just about inflation, I have future needs, I'm trying to figure out what my actual commitments are, my domestic expenses. Now, what about the taxes that go with this?
Taxes in the situation of, again, Internal Revenue Code qualified structured settlements, tax implications are none on the part of the injured party. The plan's put in place. It meets the definition that the IRS gives us.
Tax-free income for whatever.
No federal, no state income tax on the income that's paid out of that structured settlement.
Well, that's kind of comforting, I guess, if I'm going to go through a trauma of life. That adds to it. How do I satisfy, what happens if I need to satisfy a judgment against me?
Right.
I'm the bad guy now. Okay, I did something wrong.
You're now the nail, not the hammer in that
Right.
situation. From your standpoint now, it's from the standpoint that you're saying, I have a liability claim against me. I've now put this agreement in place where now I owe this lump of money to an injured party. Well, in that situation, I want to make sure as the payer in that transaction that that satisfies any remaining liability, that this is put to bed and we're done with it. But also now with the tax, from the tax situation from on my part, I'm able, because of that lump sum agreement payment, I now have current year tax deductibility, again, within the Internal Revenue Code on that lump sum payment. So there's some benefit to me as well, even though I'm the one who's providing the payment to the injured party.
Do these injured settlement discussions or conflict, they have to go through, conflict resolutions? I'm sure there's a back and forth to finally come to a settlement.
Mediation.
How long does mediation take? Steve, how long does it go
Depending on the unique case, and again, my experience has been they can be a very amicable, very, kind of a, finite period of time, give and take, and a resolution is made. But again, you add any layer of complexity or, the relationship between the parties involved, it can be a complicated and somewhat protracted process. Again, the key being that both sides are representative and the expectations are kind of given to them as far as what the process is going to be and how long it might take.
Now, on all these settlements, again, we go back to our industry, these are really being taken care of. The solution, product solution, is almost always annuities.
Correct.
Okay. And is it different kinds of annuities? A settlement itself, is that a annuity, or is that a shelf life or a shelf product? Or no, this is a specific annuity built just for settlement options?
First part of the answer, fixed annuities. 99.99% of structured settlement annuities are fixed. Obviously, we'll probably see some others enter into the fray as time goes on. As far as a shelf product or something that's uniquely designed, this now comes down to that agreement and making sure that the tool is built to fit that agreement, so that the payout scenarios, is it all an immediate type of an income stream? Maybe there's a deferral period involved. All of this goes into the design of that product or a version of that product that the carrier is going to underwrite and guarantee for that specific purpose.
Well, Steve, this whole week you've enlightened me. I've walked into a whole new idea. I thank you for being on our show. That's all the time we have for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? You can hop out to our site, downtobusiness.ashbrokerage.com, and you can check out our archives and watch any of the shows you've missed. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant, and we'll see you next week.